Hey, it's Mike Lynch at AmeriFirst Financial, and it's time for your Monday morning mortgage update for the week of November the 14th. Hope everybody had a great 3-day weekend. We honored veterans on Friday. Thank you so much, veterans. So many of our clients are vets, and we are just so thankful to be able to serve and help you. All right, so what's happened? What happened last week, and what's going to happen this week? Last week, short week. We had a 4-day week because Friday was the markets were closed because of Veterans Day, and Thursday. Oh my gosh, what a day! I just want to show you the charts here. So we know this shows the trading of mortgage-backed securities in the bond market, which is where mortgage rates are determined. And when we see red, it means, and the downward movement in this chart, it means money's flowing out of the bond market and rates are going up. And we see the green, money's flowing in and rates are getting better. Well, look what happened on Thursday. Unbelievable. Over a 200 basis point improvement in one day, the largest single day improvement in the bond market that we've ever seen. And what this means is, let's say I quoted you an interest rate on Wednesday afternoon, and let's say that rate was 6.5% and it was par. No cost, no points, right? We call that a par rate. At the end of the day, Thursday, that same 6.5% now would have given the buyer 2 basis points back, 2 points. Well, let me look at it differently. Let's say I quoted you a 6.5% and it cost 2 points to get that rate on Wednesday afternoon. On Thursday afternoon, that same 6.5% was par, no points. So that's how many basis points the market shifted. Huge shift. Why? Because CPI, the Consumer Price Index, came out, and that is a key measure of inflation. And that showed that inflation is starting to abate. And it still went up. It just didn't go up as much as the market expected, and it hasn't gone up as much as it's gone up the last 26 readings. So we've seen inflation go up 26 readings in a row, and this was the first time it's gone down. It's gone up at a lower rate. So a lot of misinformation out there about this. Inflation is still at a 40-year high. It's just showing signs that maybe what the Fed's doing as far as raising the Fed fund rate, maybe that's starting to work. And maybe we're starting to get a little bit of control on inflation. We're not out of the woods yet. Inflation is still up, and the market actually reacted negative to it today. You can see up in the top right, we're down 42 basis points. So even though we ended Thursday up over 200, we've already taken off 42. And at one point, it was down 60 basis points this morning. So the market's correcting. It always does this when it overreacts. But the good news here is that what the Fed's doing is starting to work, and it's starting to abate inflation, which means that we're going to see rates start to come down in the next 6 to 12 months. And remember, Fannie Mae says rates are going to come down by low fives by this summer. We could see that even happen a little bit sooner. Again, I want to reiterate, we're not out of the woods yet. We still have a lot of data that's coming out that says inflation is a problem. And that a recession is looming, and it's here, and it's going to get worse. But this is what happened on Thursday. So what are we looking at this week? We actually have some more inflationary news this week. So that's the one thing. A lot of data is coming out. That's the second thing. And then I'm going to give you a tip at the end of this video, something that you can use to advise your clients. So inflation, PPI is coming out. This really is the front end. What businesses are paying for stuff. And the question is, if they're showing more inflation, are they going to pass that cost down to the consumer, which they have been doing? So we'll look at the PPI this week. If it is high, if it's above expectations, the rates are going to go up. If it's low or below expectations, the rates could get better. PPI typically isn't as big of a rate mover than the CPI report. Secondly, a lot of data coming out this week. Retail sales are coming out, housing data. It's going to show that our market is absolutely in a correction, and we're going to see probably a lot of data that's not going to surprise us. We don't expect that to move rates that much, but the retail numbers could come out leading into the largest retail season. Are consumers going to spend more money? Are they starting to spend more money? Black Friday's coming. I mean, everybody's doing pre-Black Friday sales. So what are those numbers going to look like? Now, remember, those numbers are always about a month old. So we're really not going to see the retail sales numbers for the season until January. But are we going to see a sign that consumers are going to spend less? And what do the credit card numbers look like? Is revolving debt going up? So a lot of that data will be coming out. And then I want to talk to you about a tip. So if you look at the link below, there's a video that I recorded that compares buy downs. There's a lot of different buy down options out there, but I really looked at all of them and looked at return on investment for all of those buy downs and give you a different perspective on how you can advise your clients or how we can help you advise your clients. So check that out below. I hope you have a great, productive week. We're floating right now. One more thing, we're floating. And if the market starts to shift on Tuesday, which is when that PPI comes out, we'll move to a locking position. But we think there's more room for improvement than decline. Have a great productive week, and we'll talk to you soon. Bye-bye.